Here's a memorable takeaway from today's show.
Asset classes don't die, they just go to sleep for a while. Usually what happens is the macroeconomic backdrop changes. That's what changes the asset class performance. And I think regardless of what happens, recession or no recession in the coming months, I think you've seen a macroeconomic backdrop change driven by how the US wants to participate in global trade, driven by how the US wants to participate in global defense. And that's where I think you're going to have new leaders going forward.
That's Brent Schutte, Chief Investment Officer at Northwestern Mutual Wealth Management Company. And in an expansive big interview, he says that asset classes don't die, they just go to sleep for a while. Worth remembering the next time you hear someone say that this asset class or that one is dead and not coming back. Brent does think that the economy and the stock market are coming back, though he doesn't think it's going to be the same kind of rally we've seen over the last couple of years. But the National Association for Business Economics, its members see the economy slowing down and inflation staying high into 2026. That's their mid-year outlook, which they released today, and which I'll discuss first with Brian Lewandowski, a college professor, but also a survey analyst for the NABE. Plus, David Traynor, founder and president at New Constructs, here to finish their trilogy on dangerous dividend stocks. First, it was false dividends, then fake dividends. This week, dividend traps.
Make it so.
I have made it so. I've made it so that you can hear those three terrific interviews. Welcome to Money Life. I hope you had a great weekend. I hope you enjoyed Father's Day. For me, a quiet and relatively relaxing weekend. A lot of stuff I've got to get done. I'm just a busy guy generally these days. So tried to get a fair amount done. Made some fabulous ribs on the smoker on Sunday. That was what I was eating for Father's Day dinner. I know some people would say you're supposed to have someone else cook it for you on Father's Day, but my kids are not where I'm at. I'm totally fine anytime I get to eat ribs. But I hope you enjoyed your weekend and you're ready to get back at it. This week, of course, a shortened week because Thursday is Juneteenth, which now is a national holiday. So we get the day off if you're like me and you don't work on days when the market is closed. So we'll only have 4 shows for you this week, but we've got things to cover because, well, heightened tensions in the Middle East and a number of other things, but this week also has a Fed meeting. And so the obvious question is, you're going to get a Fed meeting and is something going to happen that's going to help the market break out of its range and maybe set those new highs that people have been telling us about? The market might get to where it gets the new highs, but it's not going to be because of anything the Fed does. Now, my guests don't always agree with me and I don't always agree with the guests, but I will tell you that I don't believe, and I've said it before, I don't think we're getting a rate cut this year. When everybody else is saying 2 rate cuts, I'll take the under on that. I think that the numbers keep suggesting that we're not going to get one. And I will point out, we've expected a spike in inflation from the tariff issues and the trade wars, but that hasn't materialized yet, right? We've had mild data on consumer and producer prices for May. I mentioned the heightened tensions in the Middle East. Well, on Friday, we saw oil futures go up as much as like 15%, but then they basically fell that back on the same day. So it didn't last very long. That's not to say it couldn't come back. But if we haven't had the spike we expected on inflation, the question is, are we going to get it? And will it be as bad as expected? Because, of course, when we first were expecting an inflation spike, we were expecting on much higher tariff levels than we're likely looking at now. We have a ways to go. July the 9th is when we expect to see official decisions. The Fed, which wants to be data dependent, I suspect they're going to want to keep rates at current levels for longer. And the earliest you could see a rate cut would be maybe September. And that's only going to happen if they believe the current slowing would go all the way to a recession. At least that's what my take is. Whether or not that's what everybody else will say on this show, well, that's why you tune in every day. My name is Chuck Jaffe. I'm a financial journalist. I'm the host here on this show. Money Life is independent personal finance talk. We are dedicated to looking smartly at a wide range of approaches and opinions on investing, on money management, on personal finance, on the pocketbook issues, all that stuff that concerns you. And if there's stuff you'd like to hear us talk about, by all means, suggest it. Tell me what it is that you're hoping we'll cover, and we will do it. Now, we can't do things all the time just for one listener with a specific interest. I know that there are one or two of you who are planning to retire overseas, for example. And yes, I want to make sure we cover some of that stuff. And there are times when you've got good questions on that. And it's good to cover because it's the kind of thing that others might want to consider. And at the same time, you might be interested in a show that's all about that, but we can't do that every day because that's not going to appeal to everybody. Yet the market stuff and talking about dividend stocks, that is right up there for most of you. But we've had a couple of people say, oh, could you do a little bit more on basics? We had a number of questions that have covered more basic things, et cetera. Sometimes it's people who just want my opinion on something like, what would you do about this with an inheritance or something along those lines? Don't be shy. Send your questions, your comments, your suggestions, whatever, to chuck@moneylifeshow.com. I would love to hear from you. And yeah, we try to do what we can to help you out on that front. But I also want to remind you, this show is not light lifting. Like if you're expecting, they're going to pick my portfolio for me or tell me which things to buy. While you can get buy and sell recommendations here when we do the market call, et cetera, this is not that easy. What we want to do is bring you a lot of different opinions. So you shouldn't be surprised if one day you hear somebody say, buy this, and the next day you hear somebody else say, sell it, because it's happened many, many times. You have to decide whose side you're on and what you believe in, and then go invest with the courage of your convictions, hopefully bolstered by the opinions you get here. Brent Schutte's opinion today, really strong. Great stuff. David Trainer, I love the trilogy here on dividend things because, frankly, it's a good message to get. And Brian Lewandowski, the economists and what they see happening, it is important to get an understanding of where they're going as a group. And then again, to sort of see when you've got someone on who is an economist where they disagree from the pack, right? But this is the way I see it, is that NABE is the pack of corporate economists. So that's what's coming. That's why we're here. And maybe what's not coming if you consider my comments on the Fed and a rate cut. But let's get to it. Yeah, sometimes I crack myself up. The interviews start with the Economic Outlook Survey released today when we get back in just a moment.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
We start this week's interviews on Money Life talking about what the survey said. Welcome to The Survey Said here on Money Life. It's where we talk about surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And this is one of those surveys where we prove again that economists are people too, because we are looking at the June 2025 Outlook Survey Report from the National Association for Business Economics. It is out today. The economists, well, they have their opinions. You may or may not agree with them, but these are people whose opinions we want. If you want to find out more about what we're discussing, you want to get the survey results, go to nabe.com. That's the website for the National Association for Business Economics. Joining me now to discuss the survey, Brian Lewandowski. He is a survey analyst for NABE. He is the executive director of the Business Research Division at the Leeds School of Business at the University of Colorado in Boulder. Brian Lewandowski, welcome to Money Life.
Thanks for having me here, Chuck.
The fact is that NABE did something in April that it doesn't do all that often, which is it did a flash survey because, well, hey, we had Liberation Day and everybody was freaking out. So now we're back to your regularly scheduled programming, coming out with a June outlook. Things are calmer, but they're not a lot more optimistic, are they?
Yeah, I think that's a good way to describe it. There is a lot of quick changes, a lot of chaos that was happening earlier in the year, and we saw that reflected in the last survey. And that's why NABE ended up doing the flash survey, was to try and keep up with some of the rapid changes that were happening in the economy and with the announcements from the administration. So they did the flash survey in April 2025, and now we're back more on steady ground in June 2025. And I think what the results are showing us is that the expectations have moderated a little bit from April to June. They're a little bit better in some circumstances compared to that April flash survey. So you mentioned Liberation Day. We saw expectations deteriorate a little bit after Liberation Day, and now those expectations have perhaps come up a little bit since then.
Functionally, what we really are seeing is higher inflation for a longer period of time and sluggish economic growth, but not a lot of, oh my goodness, dire things are happening, expect recession or worse. Correct?
That's right. So the expectation is that we'll have continued gross domestic product growth, real GDP growth adjusted for inflation in 2025 and 2026. But panelists were asked about that R word, the recession word. And most panelists don't think there's a recession that's imminent. Most of them actually think it's further out, 2027 or after, which is really just saying that we're not on the cusp of a recession right now.
Inflation was expected to rise. What was the take on how, if, when the Fed would act if they want to be fighting inflation?
Yeah, so we saw a couple of things related to Fed policy in here, but on inflation specifically, the expectation is that inflation will be elevated as we march through 2025 and into 2026. So when I say elevated, that rate is over 3%, but we're not looking at hyperinflation or inflation like what we saw in 2022. So I like the word elevated inflation. What we also see in the survey is that panelists are expecting lower job growth, softer job growth later in the year. And all of this coincides with softer economic growth, slower GDP growth in the second half of 2025. Related to that, we know that Fed policy is really targeting two things: full employment and stable inflation. And if we expect inflation to be stable at or just above 3%, but we see softening in the job market, it's logical to think that the Fed could move on interest rates. When panelists were asked about their interest rate expectations, we did see that the expectation is for the Fed to cut rates, or the FOMC to cut rates, in the second half of 2025 and in the first half of 2026. So the projections are for 50 basis points in second half of 2025 and another 50 basis point cut in 2026.
Was there any sense of the economists having some reservations in their forecasts? In other words, really saying, hey, thanks for asking, but I won't know anything for sure until after July the 9th, when we're going to get hopefully the second or the next shoe to drop on tariffs, and maybe the final or clarifying shoe to drop when we get there. And were they saying, we'll talk to you in the next flash survey next month?
When we report these numbers out, we do show the distribution to some extent of these numbers. So it's not unanimous that there's an expectation for rate cuts in 2025 or 2026. It's often a consensus or a plurality of panelists will speak to some of these expectations. But there are some people that put those rate cuts off a little bit further, or they'll simply tell us that they don't know, they're unsure. And I think that speaks to the uncertainty that remains. And whether you report an expectation of rate cuts or not, we continue to see uncertainty as a general theme when talking about the economy.
One of the interesting things is that the evolution of the survey, you're always looking at things that are going on. You now have tariff questions in the Outlook survey, and the economists are saying what we're seeing now, 10 to 15%, that's probably going to be it most of the world around. Yes?
Right. So a majority of the panelists expect that the average tariff rate will be 10 to 15%. So when I'm reading about the tariffs, we've got sort of the global rate right now at 10%. And then there's some select countries that have higher rates. And so if we're looking at an average tariff rate of 10 to 15%, I think that suggests some moderation in, say, the tariffs with China.
Given tariffs and where folks think we're going to be when it comes to inflation and their inflation expectations, do we wind up with any forecasts on what's going to happen with the consumer? Because, of course, all the soft data says consumers are really unhappy, but all the hard data has, to this point, not really gotten to where you're that worried about it. But it's starting to show some cracks.
Yeah, so I think that's an interesting question. We can measure that in a few different ways. So, one thing that the panelists talked about is this expectation that the tariffs would be inflationary. And so, again, a majority of panelists think that there's this inflationary pressure due to tariffs. But when we take a look at personal consumption expenditures, which is one component, a major component of GDP, we see that there's been sort of little change from the initial April survey to the June 2025 survey. So back in April, the first reading in April, the expectation was for 2.4% growth in personal consumption expenditures in 2025. Now we're at 2.3% growth. So that's fairly unchanged. Compared to that flash survey in April, it was 1.8%. So that shows where there was a lot of concern about consumption headwinds because of the tariffs. And now we've seen that resolve a little bit. And so the PCE expectations have come back to where they were in early April. So what's the other piece of that? And it's that inflation expectation. And we do expect inflation to edge up a little bit and remain higher than what we expected late last year and earlier this year.
Again, the forecast here, the outlook is not for recession anytime soon. It seems to be, if we're expecting one, we're going to get one in 2027 more than we even get one in 2026. The other takeaway from that is not having a recession is not the same thing as having really strong growth, because nobody's forecasting that either, right?
Right. So the forecast for 2025 and 2026 for GDP growth, it's just a top line measure of overall economic growth. It's slower growth than what we had in 2024 and 2023. So we see that sluggishness, the slowing trajectory, show up in multiple components of the economy. That includes GDP, and it includes employment growth. It's just we're expected to continue to grow, albeit at a slower rate.
Brian, really appreciate your time and your perspective. Thanks so much. I know we'll be reporting on some NABE surveys down the line. Hope we get a chance to chat with you again.
Thanks, Chuck.
That's Brian Lewandowski. He's Executive Director for the Business Research Division at the Leeds School of Business at the University of Colorado in Boulder. He is a member of the NABE Outlook Survey Report. And we've been talking about their June 2025 Outlook Survey. You can find out about it at nabe.com. We have it linked up in our show notes and on our guest page where you find Brian. Up next on Money Life, danger. We are heading for the baddest biker bar in the investment world, the Danger Zone. Stick around.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
If you're looking for trouble, you've come to the right place. You're in the baddest biker bar in the investment world. This is the Danger Zone. Welcome to the Danger Zone on Money Life. It's where we get the latest take from the experts at New Constructs, which has a unique way of looking at the market. It brings together discounted cash flow analysis and forensic accounting, digging in at the footnotes level, working their way up. And what they find often is that the skin-deep picture is a little bit misleading. Now, if it was misleading and it would work in your favor, well, that would make something attractive. That's not what we focus on here. No. We are looking at the Jeppson's Malort of stocks. Jeppson's Malort, for those of you who don't know, is like supposed to be the worst tasting alcohol ever. It's on sale in the Danger Zone. But if you want to find out everything that's on sale in the Danger Zone, you want to find out the stocks that are there and more, go to newconstructs.com, where they have all the details you need. David Traynor is founder and president at New Constructs. David, great to chat with you again.
It's great to be back, Chuck. Thank you.
Who's in the Danger Zone this week?
Dividend trap stocks.
Danger.
Dividend trap stocks. Now, this is completing our trifecta. It started 2 weeks ago with you talking about fake dividends. Then last week, it was Kyle Gusky here talking about false dividends. And now you are back to complete the trifecta with dividend traps. And I know we're going to have an example, etc. First, help us understand what a dividend trap is and why a dividend trap stock is inherently dangerous.
Yeah, they're sneaky, dividend trap stocks. They look good on the outside. They're paying a dividend, and they got good fundamentals. They can afford to pay the dividend. But the problem is you have a relatively low yield because the stock is so expensive. And the capital risk or the risk of the stock going down dwarfs the payout ratio. So it's a net negative situation is the way I'd put it. And that's where we think people often get misled when it comes to dividend stocks in general. They think, oh, I'm getting a dividend. That's great. I'm getting some income here. But if that stock goes down, you're going to lose more money than you make. And people need to be mindful of that.
You know, there's a problem inherent in chasing yield. You and I understand it. I think the audience understands it, but that doesn't mean that they can look away or, close their ears to the siren song of here's a high yield, we're paying you a regular whatever. So I'm going to ask kind of a chicken and an egg question. For somebody who was a yield driven investor, which do they need to look at first? Because that's what a dividend trap is telling me is, do I look first to evaluate the dividend or do I look first to evaluate the stock price?
Chuck, I think the whole purpose of this series of work we're doing on dividends is that investors deserve both a good dividend and a good stock. They shouldn't be forced to choose between the two. The challenge is that it's hard to find both. There's not many out there. It takes real work. And so the answer to your question, is both. You need to make sure the dividend they can afford the dividend. It's a decent sized dividend, and you need to make sure it's a good stock. And that just takes a lot of diligence. You got to understand cash flow. You got to understand valuation, the things that we do at New Constructs to help our clients make money in any kind of market, the diligence that we think is what matters long term. But there's no shortcut. You got to do both.
So let's dig in a little bit on let's do it at both ends of the spectrum. What makes a good dividend stock? Because you identify those at New Constructs as well, and it's a very small pool. And then are the dividend trap stocks, is there as big a pool of dividend trap stocks or is it a bigger pool of dividend trap stocks? Help us understand how small the group is of good dividend stocks by your rating system versus dividend trap stocks.
Yeah, overall, we cover about 3,400 stocks. That's like all of the stocks that matter. We're trying to up our coverage these days, and we can't hardly because there's no stocks worth covering, to be honest. They're so small or whatever. So we're struggling a little bit with that. But 43% of our coverage universe, 43% of that 3,400 pays a dividend. 13% of the overall universe is a dividend trap stock. Only 1% we consider to be a good dividend stock.
Is there a valuation level? Is a dividend trap stock inherently 10% overvalued, 20% overvalued? At what point do you say you're heading towards literally the danger zone, not just us in the danger zone, but what is the danger zone for you in terms of how much you're expecting a stock to get hammered? Does that wind up, making it a dividend trap?
It's hard to put a single percentage on there because we're talking about so many stocks. But the key metric that we're looking at is a very unattractive market implied growth appreciation period rating or market implied gap rating. So that metric is one of our strongest in the overall 5 metrics that drive our stock rating. It's our reverse DCF model. And typically we're seeing, stocks that are dividend trap stocks need more than 100 years of profit growth to justify their stock price. That's what that growth appreciation period measures, the number of years of profit growth required to justify a price. And it's a great metric. It's a great metric for understanding valuation, and it's one of the most predicted that we have. So when it's that high, you're looking at stocks that got a lot of downside, Chuck. I mean, you're talking, not just 5 or 10, it's 10, 20, 30, 40 kind of downside when stocks are that expensive.
And let's point out that it's the fake dividend stocks and the false dividend stocks that are in jeopardy of really cutting their dividend. The reason that these are dividend traps is that it's not going to be like with a dividend stock, if they cut the dividend, you expect the stock to get hammered. That's not it. The answer is you expect these stocks to get hammered, but not cut their dividends because they don't need to cut their dividends, correct?
That's right. That's why it's a trap. We're trying to figure out names for this one in the beginning. We're like, oh, boring dividend stocks. Anyway, we had some bad names, but dividend trap is much better because it does look good on the surface. It's a good business, but a good company is not always a good stock. And here we've got good company, bad stock, which means that and that dividend is just not high enough to justify the risk in the stock. And dividend trap stocks they have low dividend yields, below the risk-free rate or 5-year zero coupon rate, right? So you can get that kind of yield with a whole lot less risk somewhere else as part of the idea.
Yeah. And of course, a value trap, which is a recognized investment term, is a thing that looks like a value stock that's not a value stock. So it makes sense. So let's put it to brass tacks. Give us the exemplar for a dividend trap stock.
Yeah, WD-40 trades at $244 a share. It's got a 1.5% dividend yield, great cash flow, but the stock price is really expensive. The price to economic book value ratio is 3.1, which means the market is already implying or expecting that the company's profits are going to improve 300%. And then when we look at our reverse discounted cash flow model, the stock gets a very unattractive rating for the market implied growth appreciation period. So it's really expensive. The no growth value of the stock, Chuck, you always like me to share, is $80 a share or 67% below. So, that's a lot of downside. There's a lot of difference there. Or in other words, there's a whole lot of growth priced into the stock, way more risk that stock comes down than, you're going to get paid for to wait with a 1.5% dividend yield.
Yeah. The answer to that one is if it's losing 10%, let alone 67%, at 10%, you'd have to hold it for a long time for that dividend to make you whole. That's not what anybody's investing for.
That's right. Yeah. And look, stock like WD-40, there's not like a lot of growth and innovation potential there. You know what I'm saying? It's like probably going to go down every year for a while when it's already that expensive.
And, I was asking for a certain number in terms of whether there was one, but dividend trap stocks, obviously it has to have an attractive enough yield to be a trap, but what is the range of dividends here? Because again, at 1.5%, WD-40, which is WDFC for anybody who wants to check the ticker out, it is not like, oh, I'm going to buy this necessarily for the dividend. It's a stock that's been, rising to this high valuation and it pays a dividend. Cool. I'll take it. So is there a level for you or a range of dividends that the dividend traps have, like a low and a high to you?
Yeah, Chuck, the answer is it's not an exact number for what the dividend yield has to be. It's really that it's a lot lower than the risk in the stock. It's an inconsequentially low dividend compared to how much downside risk we see in the stock. And that downside risk is, in the double digits. These aren't going to be super high dividend yields either, though. We're talking, in the low single digits for sure.
Yeah, because if they've got the high dividend yields and they're a problem, then they might be fake dividends or false dividends. It's the stocks that are overvalued. So you're getting a dividend, but it's not nearly the plus you think it is. Those are the dividend traps. David, great stuff. Love the 3 weeks in a row focusing in on dividends. Appreciate what you do for us. We'll talk to you again next week.
Thank you, Chuck. Good to be with you.
David Traynor is founder and president at New Constructs. Go to newconstructs.com to learn about how they do their research to get more on false dividends, fake dividends, dividend traps, zombie stocks, smart money risk, all the things we talk about here on The Danger Zone. And since we are going to keep talking, we'll take a quick break, and then we will come back with Brent Schutte from Northwestern Mutual Wealth Management. He's here for the big interview when Money Life returns in just a moment.
Oh, wow. This is actually pretty dangerous.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Welcome back to Money Life, where it is time for the big interview on the June 16th edition of the show. And returning to the show today, Brent Schutte. He is Chief Investment Officer at Northwestern Mutual Wealth Management Company. If you want to learn more about him and the firm, it's northwesternmutual.com. But I wholeheartedly encourage you to add /market-commentary, because if you do that, you will get to Brent's pieces. He writes regularly on the market, and it's worth taking a look at it. Brent Schutte, great to have you back on Money Life.
Thanks for having me, Chuck. Nice to be back.
You and I last spoke, about 6 months ago. And I have to say, on the one hand, if I look at it, you got it right. On the other hand, you didn't necessarily get it right when it comes to how we were going to achieve things. But what you were telling me when we talked about 6 months ago is that 2025 is going to prove that diversification is not dead. I think we've gotten that proof. But you also said we were going to wind up having small caps have a big rally and some other things along those lines. And you've been expecting a recession for a long time that hasn't come. So as we move from what was your outlook for 2025 into your outlook for the second half of the year, A, are we still looking at the same outcome, just a very different path to get there? And B, what's on the horizon next?
Yeah, I think from the standpoint of the economy, the risks are still high. I mean, certainly you've seen tariff uncertainty, which is still elevated, but it's come down, and that's kind of supported the risk rally that you've seen. I think the biggest question that comes next is, does the soft data, which has deteriorated, so the survey data, does that actually start leaking into the hard data, such as the labor market, such as inflation? And that's where even last week you noticed we had a couple of inflation prints that were a bit lighter, but I don't think that's coast all clear. I think there's still likely inflation in the pipeline with the tariffs that are on. I think on the labor market side, you have seen it weaken from the standpoint of, I know the jobs report was positive, but if you look under the surface, for example, on the non-farm payrolls, only 50% of the industry is actually hired, down from 51.8 in the prior report, which if you look historically, those are all periods of economic weakness where you see readings like that. And I guess we'll see where we go forward as kind of this tariff uncertainty continues to linger. I think the one big thing that you have seen is the consumer has certainly pulled back their spending. And so if you look at the first quarter GDP, which was kind of all over the place because of the pull forward of consumer demand, the pull forward of import demand, the pull forward of business demand, consumer spending only rose 1.2% quarter over quarter, which is the slimmest quarter since, I believe, the second quarter of 2023 when we were worried about a banking crisis. Then you actually had April's PCE report, our spending report. It only rose 0.1% on a real basis. Throw in the beige book from the prior week, where you saw a commentary of 6 of the 12 districts reporting slight or moderate declines, 3 no growth, and 3 only slight growth. The sentence that came after that talked about consumer spending being challenged or being down in most districts. And that's where I think you're kind of seeing some of the stresses that are still in the consumer starting to play out, which maybe back to your original recession question, we've had a really bifurcated economy where you've had the weakness in manufacturing, you've had the weakness in housing. That's where you've seen the impact of rate hikes. I think the reason why we didn't have a recession is 1, government spending, and then 2, just AI, which held us up on all the spending that occurred there. That's where you also saw that in the market, where the market was up last year and it was up the prior year, but it was really driven by a narrow band of stocks, which as you opened with, I expect to widen out in the future into small and mid cap stocks. And then I think the new entrant to the party of diversification party is through the international channel, which I think all this action that we've had over the past few months has started to wake up the international markets. And I think that will continue into the future.
So we're going to get a broadening out. Is the rally that we have seen the beginning of the next rally, or is this been, a bear market rally and we're going to go back and retest those lows?
That question is incredibly hard to answer, just given the administration and all the back and forth that they've added to the kind of outlook. And so we do have the tax bill coming through, which will provide some stimulus to the economy. And then I don't know if anybody knows what actually happens on July 9th. And that's certainly, as you saw on April 2nd, and thereafter weaves into what actually occurs going forward. Look, I think we're still later in an economic cycle. That brings and makes the risk of a recession higher, which brings and makes the risk of a market decline higher. Timing unknown. And that's where it's so hard to kind of figure out. If we could all time this perfectly, I wouldn't be doing this interview with you. I'd probably be at the beach or golfing or whatever it may be. And that's where I just think you just have to be a bit careful towards the end of a cycle. That's where if your allocation should be 60% equities, make sure it's 60% equities. And please don't fall prey to concentrating in any one particular asset class just because it has done well over the prior few years. Because a review of history, which you can get all these slides and charts off our website, as you mentioned, shows that asset classes don't die, they just go to sleep for a while. Usually what happens is the macroeconomic backdrop changes. That's what changes the asset class performance. And I think regardless of what happens, recession or no recession in the coming months, I think you've seen a macroeconomic backdrop change driven by how the US wants to participate in global trade, driven by how the US wants to participate in global defense. And that's where I think you're going to have new leaders going forward. And that is my biggest message. Please just don't concentrate in 10 names, 7 names in US large cap stocks, and make sure you own a lot of the rest of things, and make sure that you're at your allocation just because I don't think it's going to be straight up into the right with equity markets.
Not straight up and to the right, but what kind of expectation for gains do you have? Like historically, it's been 10% on stocks long term. If you're talking large cap stocks, a little bit better for small cap stocks, et cetera. If we're into any sort of long term muted cycle, are you telling people at this point, think more like it's going to be six and six for a long time? Like get the double digits out of your head and count your blessings if you get there?
I think the post great financial crisis period where I believe the large cap markets averaged 15% per year is over. And that's where I think valuation matters quite a bit as a starting point mechanism. That's why we're a little bit less constructive on large cap stocks, because they do trade at 23 times earnings. And that's historically elevated, especially when bond yields are in the 4.5% range. The CAPE ratio, for example, is something that people look at. It would point to a more challenged environment for large caps, but this is where that's not a pessimistic commentary, because there are other opportunities. And this is where I always bring back in the late 1990s, because it was a similar setup where large cap stocks did very well. We had an extended economic cycle. Back then, it was the internet spending that kept us out of a recession, I believe. It was also Y2K spending. That really narrow spending in the economy, while the rest of the economy kind of languished, held us out of recession. But that always shows up in the market where you had those particular segments doing well. What happened over the coming 7 to 10 years was that the large cap area, which was expensive back then, didn't do so well, but the market broadened out to include small and mid cap stocks. It broadened out to include international stocks. And that's where I think you see a similar blueprint going forward, where you get better returns out of those parts of the market, albeit I do think returns will be less overall. I think the good news now for those that actually own some sort of combination of stocks and bonds is for the prior 10 to 15 years, bonds provided none of your return and stocks did all the heavy lifting. That's where I think, even with the worries that I have about fiscal policy going forward, which we can discuss, I think bonds now actually provide some sort of return mechanism for your portfolio going forward, even if stock returns are lower. And so that's where I think there's just a more balanced act, and maybe just another indication of a broadening out of just being performance driven by large cap into other asset classes.
That means you believe that the relationship between stocks and bonds has normalized, that we're not going to see a repeat of 2022 if we wind up with the market tanking, even though we've got these overhangs.
This is where I encourage people to own another asset class called real assets, whether it be commodities, gold, or whatever you want to call. If you think about it, and this is where people didn't want to own those until 2022 when they actually performed well. Post the great financial crisis, you could pretty much hedge an equity portfolio by owning fixed income. And the reason being is that the big risk then was one-sided to your portfolio, to equities. It was too little growth and deflation. Now I think we're at a point, which 2022 showed us, and even going forward, where the other side of the equation, called inflation, is certainly in play. That's what deglobalization sometimes can do. That's where we have heightened debt levels, which we could decide to try to inflate that away. Certainly, I think that's tail risk is out there. And so I would encourage people to not just own fixed income and equities, but also think once again about an asset class which has been historically unpopular just because it didn't do well during that time period, but has performed well lately, to own something like even a broad basket of commodities to hedge against that side of the distribution. It doesn't have to be a large position, but certainly I think some is better than none. And taking you back to 2022, Chuck, stocks and bonds were down, commodities were up. And if I go back historically to 1926 and I look at an annual basis, when stocks have been down, I believe it's 26 years, bonds hedged 21 of those, the 5 that it didn't hedge, 33, 46, 69, 73 in 2022. Set aside 33, that was the Great Depression. I don't expect that. In the other 4 instances, commodities provided double-digit returns. And that's where I think people should think about inflation being a risk again, that they should think about in their portfolios going forward. And that to me means a sliver of real assets in those.
And you don't worry, for example, if real assets means gold, that gold has had this nice rally. And, is gold a separate asset to you from the other real assets?
Yeah, I mean, I think it is, but we've owned gold in the past. We unfortunately don't own it now. We own a broad basket of commodities. And that's where I think you can still get similar types of hedges. And that's what my historical analysis was using, commodities. And certainly if you own a broad basket of commodities, you do own gold within there. And so that's where I do think going forward, if you want to diversify and just make sure that you're in other things besides gold, oil, which you're seeing, rise again a little bit on some Middle East tensions, that's where I would own the broader basket of commodities. In full disclosure, we are slightly underweight equities. We have a slight overweight to fixed income. and a slight underweight to commodities, just given the reality that I think at some point, and back to my commentary on a late cycle risk, I think the risk still is to the downside in the economy, not yet to the upside, just given all the uncertainty and shaking that's out there. Can we get through this without a hiccup? And I think that's still, left up for grabs.
Well, let's talk about the grabs that are involved here, because we've come this far into the interview and we really haven't talked tariffs. We really haven't talked rate cuts. You are cautiously optimistic, muted returns, be diversified. There is a path forward that should be upward, though you worry about the downside risks. How much does all of that get thrown into a mixer if the tariffs on July 9th don't get extended at current levels or what have you? We wind up going back to draconian levels, or if we wind up with a lot of tension between the president and the Fed somehow makes what somebody considers a mistake.
I don't think the tariffs are going away. I think the question is at what level are they going to be put on? And you can read Stephen Moran, who was the CEA chairman. You can listen to Scott Bessent. There's a definite belief that these tariffs are needed. And there's a belief that we have provided a security blanket on the defense side, and we provided the financial assets and the securities, the dollar, the markets that make global trade available. And global trade and that security blanket have led to an expensive dollar, which they believe has been borne on the back of hardworking Americans who have seen their jobs go overseas because of the manufacturing side of the equation. And they've hollowed out, and that's created a national security risk that has also led to a fiscal deficit that we have that's rather large. And so I don't think they're going away. I think they need them for revenue because the budget deficit, which hopefully we can get to it at some point in the not just this year, is getting a little bit dimmer as we go along. So I don't think they're going away. This is where I think the tariffs are going to be at levels they're going to be at least where they are today. And that begs the question of what happens next, and does this actually cause a hiccup, which I think the jury is still out. I mean, you haven't seen stagflation yet, but I mentioned in the beginning, I don't think inflation, should write it off yet. And I think economic growth has shown signs of slipping. And so that's where I think there are still certainly risk out there. And maybe just one more comment on that. I think the administration and the president was reported to be willing to risk a recession, but not a depression. That's why he pulled back. The market that he discussed being a little bit yippy, a little bit afraid, was not the stock market. That was more the bond market, which I think is interesting this time period because there's this belief that he will pull back if the market falters. I think he was pulled back because of the bond market, not the stock market. And Scott Bessent has said over and over again, this is Main Street's turn to share in the prosperity. Wall Street has done well for 40 years. It will eventually do well again. And so I guess keep that in mind as you think about the Trump put. I think it's more on the fixed income side. The Federal Reserve is on hold. I don't think the Federal Reserve is going to do anything preemptively. There is a back and forth, certainly. Chair Powell is out on May of next year. We'll see if the president, who he appoints, but I assume it'll be somewhat easier money policy, which brings me back to making sure that you're hedging the inflation side of your portfolios, because it certainly is a risk that's out there. But I don't think the Fed's going to be able to mark it out in the near term if it were to have some difficulties. And I think the president's willing to continue to push, even if equity markets slip just a bit. And he proved that in his first term, where he kept pushing until you got closer to the election in 2020, where he kind of backed away. But that's where I think there could be more shaking going forward. And that's where, yes, the question about forecasting and recessions, this is where I think it's extremely difficult anytime, but throw in a president who's operates more in a kind of back and forth and a new tariff or a tariff taken off each day, that makes it even more difficult, which just kind of ties into my be careful commentary in the beginning.
Let's talk about the trade deficit, because while we've talked market and the outlook, the long-term picture, very important on the trade deficit, especially even though nobody seems to be talking about it anymore after the last of the credit bureaus lowered our credit rating, things along those lines. So for you, is that the issue, that if we don't get it under control, we're building trouble? And when does that trouble come to roost? Or is there something else in it for you?
No, I mean, so for 30, I've done this now for 30, I'm entering my 31st year. And for the first 27 of them, I kind of pushed off the fiscal problems of the US because they weren't to levels they are today. And so we have increased our debt in a bipartisan way. So if you think about 2000 to 2007, a lot of that debt was on the consumer balance sheet. And then we started shifting a lot of that debt to the government balance sheet, to where now our debt to GDP overall is back to where it was kind of around World War II, post World War II. And most importantly, the deficit, so our annual deficit to GDP, is right around 7%, which is usually reserved for financial crises or fighting world wars. And that is expected to stay at that 6 to 7% level for some time in the future, if you believe the SIBO estimates of what the One Big Beautiful Bill Act does. This is where the reason it's become much more pressing is interest cost. Interest costs have risen because interest expenses have risen, yields have risen, to where the debt was rising from 2007 to 2023, 2024, 2022, I should say. Interest rates were low, so interest expenses were low. Now you're getting to a point where interest expenses are over $1 trillion, which is the second largest budget item on an annual basis. They're about 3% of GDP and rising. If the CBO scoring of the House version of the One Big Beautiful Bill Act comes to fruition, that would grow to 4.2% by the year 2034. That is based upon a treasury market where the yield averages 3.6%. If it, on the other hand, stays around where it is today, that grows to 5.1, 5.2%. The big thing here is that if your interest cost as a percentage of GDP or your income, 4.2 or 5.1, if they grow faster than your nominal GDP can grow, which is maybe 2 plus 2 inflation, you get into a spiral of not being able to pay your interest cost because they're continually rising above your ability to grow, which means they continue to grow. And that's where I think going forward in the future, something is going to have to be done about our deficit and our debts. That's where this administration believes they're going to try to grow out of it. But this is where, I don't know what happens in the future, but could the administration do something to try to artificially lower interest rates? I don't think anything's off the table. And this is where even in the near term, so I make that commentary, I still think treasuries in today's world are still a port in the storm, if that storm is economic contraction. And I still think there may be even the Trump put on the treasury market, whatever that means. That's where I still encourage people to own them. But I do think as we think longer term and people think about financial planning and where tax rates may be, that may be where you want to start thinking about the debt becoming more of an issue as you push forward.
One of the things you mentioned when we were talking about diversification was being more international. Where in the world are you investing and where in the world are you not investing given global markets, global tensions, trade wars, tariff concerns, and the rest?
This is where, tying back and why I take a macro approach and talk about the economy so much. And I kind of open with Myron's comments and Bessen's comments. This is where I think they believe the dollar has been, there are benefits to running a trade deficit. If you run a trade deficit, typically you have a lot of your currency floating around the world, and that tends to flow back into your financial markets. So over the past few years, you've seen our markets attract tons of foreign capital to the tune where now foreigners own 32 trillion of our securities. It's kind of been the only game in town. The administration, though, believes that rising dollar has made our manufacturing less competitive globally, which is true. If you think about it, if we produce, we price in dollars, and the euro and every other currency has fallen, when we put those on the global marketplace, it's more expensive to buy. And so this is where I think there are a variety of things that are coming to fruition. I guess one, I think the administration's actions have made foreign economies realize they need to stimulate their own economies. You've seen Germany with a defense fund, an infrastructure fund. They're realizing they need to stimulate their own domestic consumption. That may be even what they're trying to do with China, which means that there is likely to be, for example, in places like Eurozone, fiscal stimulus, which hasn't had as much, especially in Germany. You think about the falling dollar, if you're a US-based investor, and you want one metric to look at. If the dollar is rising, and this is at least since 1979, US stocks are outperforming. If the dollar is faltering, international stocks are outperforming, and it tends to move in large trends. And right now, the dollar, based upon a valuation metric called purchasing power parity, is globally expensive. I would expect, given that, coupled with our trade deficit, coupled with the administration's desires, that you would see the dollar move lower in the future, which I think is a tailwind for US-based investors, because if you take your money, invest in places like Europe, and the euro goes higher, when you repatriate your cash flows to the US, you get a higher level of return. And so that's where I think there are a variety of things coming to fruition. I didn't mention, but I think some of those capital flows will flow back out of the US into those markets. And that's where I think you have an opportunity internationally to actually have some increased returns. And you've actually seen that this year, where the international markets are up around 20%, even while the US markets are kind of languishing around break even. Just one comment on small caps. And this is where I think, Chuck, given all the uncertainty that's out there in the near term, this is where sometimes you have to pull back kind of your near-term macro forecast and rely a bit on just being invested somewhere or overweight somewhere based upon a more long-term outlook. I've mentioned doing this for 31 years, or entering my 31st year. Small cap stocks relative to large caps trade at the second lowest valuation level they have in my 31-year career. The only other time it was actually lower was June of 2000, which then ushered in, as those economic winds changed, small caps got a lift from those economic changing winds. And also the valuation was low. And that's where you saw, years and years of outperformance. which perhaps the catalyst for that is deregulation from the administration. But that's where I think anyone who's willing to take some money, and hopefully everyone on this call is willing to take some money and think longer term, that's where I think there's opportunities no matter what happens in the next 3-6 months. I think that's where there's opportunities for excess returns also for intermediate to longer term focused investors.
And out of curiosity, let's go the other way because you've been preaching diversification. So let's talk non-diversified because you said don't load up in the biggest names or what have you. But that's a warning. Are you worried that we're going to wind up seeing a slowdown in the AI side of things, that the Mag 7 is due for a headache? Or is it just you've gotten a big stretch of performance, it's going to take a breather, the rest of the things are going to come up, and so make sure you're not overweight?
I think more towards the latter of what you just mentioned. I don't know exactly what happens. I mean, think about it this way. People ask this question quite a bit in different ways. And I take you back to 1999, 1998, which I've mentioned looks a lot like this period, at least from my perspective. And I do think history repeats because we're all behaviorally flawed. That's why I think history repeats, because we are the people who push stock markets around. And that's where, back then it was Cisco and some of the companies that were laying the pipes for the internet. They're the ones who did better in the beginning. And then kind of the benefits shifted to being more broadening of actually companies who use the internet to reach their consumers. And that's where I think you've seen quite a bit of spending that has benefited a lot of these companies up front. I think the next stage is just how does AI pay us back? And I think a lot of companies are trying to figure that out, but hopefully that becomes more of a benefit to society and it broadens out from just being the companies who are putting it in place to the companies who then use it to increase their profitability, increase their margins, which that certainly margins could be under pressure, Chuck, if, we haven't talked about who pays tariffs, but certainly it's probably some combination of exporters, consumers, and corporations. And so if margins are harmed a bit or companies tend to swallow some of those price increases, hopefully AI can help push out some of that productivity enhancements. And that's where I think you're going to see a movement from just those names that I mentioned in the opening, those 7 to 10 names that were doing a lot of the internet implementation, moving to something much more broader in the future. And that's where I think, just overall, if you're looking for a theme, it's more a broadening of markets away from what has driven them the past couple of years to those that is more inclusive of other securities, other asset classes, which I think you're starting to see the early signs of.
Brent, great stuff. It always is when we get a chance to chat. You and I typically do talk twice a year, usually around this time and 6 months from now. So I'm looking forward to the next one already. Meanwhile, enjoy the summer. Thanks for coming back to Money.
Thanks, Chuck.
Brent Schutte is Chief Investment Officer at Northwestern Mutual Wealth Management. It's northwesternmutual.com. Again, add /market-commentary to get directed to his pieces. We've got it all linked up in our show notes and on our guest page, so you can do that too. And stick around. We'll be back to put a bow on this show, but we'll tell you what's coming for the rest of the week before we cross the finish line together. We're back to wrap things up on this show. That was a fun interview with Brent Schutte, and it's been a fun couple of weeks with the guys from New Constructs talking about fake dividends, false dividends, and dividend traps. I thought that was really good. Great stuff. And we've got much more great stuff this week. Now, Thursday is Juneteenth, and we are celebrating the Juneteenth holiday. But before we get there, we've got great things like Paul Christopher, the head of global investment strategy for Wells Fargo's Investment Institute. He will be here tomorrow. The next day, Julia Herman, global market strategist for New York Life Investments, co-host of their Market Matters podcast. She will be here. We've got more coming. Also talking technicals with Matt Fox, president of Ithaca Wealth Management. On Friday, Jeff Krumpelman, the chief investment strategist at Mariner Wealth Advisors, talking technicals. So great stuff there. Lock us in and plan to be here, except for Thursday when you can stand down. Meanwhile, if you're looking for something to celebrate, today is Take Your Cat to Work Day. My oldest daughter, Thompson, has a couple of cats, and she, as she calls them, chaos agents, and I think they are, and yeah, you would not want to take them to work. It is World Refill Day, and I love this idea. In fact, there's a little store in the town where I live that basically is a refill store. So in other words, you take your containers and you need soap or you need whatever, and they have good stuff that allows you to refill it without having to buy new packaging and all the rest. It's kind of a cool concept. I wish we'd see more of it. I don't use it necessarily as much as I should, but I do like that idea. It is World Sea Turtle Day, as in sea turtles, not like C-A turtle, but C-S-E-A turtles. And then on the food front, a lot of choices. It's National Tortilla Day. It's National Vinegar Day. That's, not actually a food. That's kind of an ingredient, right? It's National Fudge Day, and it's National Cannoli Day. And I will simply point out, I was never a cannoli guy till I moved to the Boston area. And if you go to the North End in Boston, Modern Pastry and Mike's are the two kind of legendary places for cannolis. There's a couple of other good ones. And people say, well, what's your favorite? And I'm like, whichever one I'm going to with friends on that particular night. I tend to gravitate towards Mike's, but that's not necessarily because I think they are better. It is typically because where I go in the North End is closer to Mike's. But I won't be offended if you try both. I can promise you that. My guests today were Brian Lewandowski, Executive Director of the Business Research Division at the Leeds School of Business at the University of Colorado Boulder, but more importantly for our purposes, survey analyst for the National Association for Business Economics Outlook Survey, NABE.com for more information. David Traynor, of course, is founder and president at New Constructs. It's newconstructs.com. And Brent Schutte is Chief Investment Officer at Northwestern Mutual Wealth Management Company, northwesternmutual.com. And I always say, add the /market-commentary, which just is because it's easy, but Brent's stuff is worth following and reading. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Sophocles, who said, "There's nothing in the world so demoralizing as money." Yeah, sadly, money can be demoralizing. It can be inspiring. It can be a lot of things. But whatever those things are, you want to keep them in the right perspective. And to best do that, please remember that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Say goodbye to Chuck.